Welcome to today's SNAP session, Dealmaking During COVID-19. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm talking with Aaron Appel, co-head of Walker Dunlop's New York Capital Markets practice, who is doing business nationwide. We are recording this session, and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. Deal volume is down 30% from a year ago, according to Real Capital Analytics, but there are plenty of investors eager to move forward as soon as valuations start to reflect the current marketplace. And unlike in more traditional recessionary environments, lenders today have the liquidity to make deals happen. Aaron, let's talk about how lenders are evaluating deals right now and how that will impact the investment arena in the near term. Deal flow has slowed significantly during the past few months. Do you see it picking up soon, and what's your outlook for the third quarter?
Sure. Thanks for having me. So I would tell you that we've seen, a similar trend that the rest of the market's seen across really all businesses, that transactional volume is starting to pick up. I would probably tell you that it's a modest increase, maybe 25 to 30% higher than what we were seeing back in April or the beginning of May. I think it coincides with the marketplaces around the country, starting to open up for business, people being able to move around a little bit more. Real estate is very much a touch and feel business, and having to actually be on site, see collateral, and understand the environment that you're investing around or lending in. So certainly any sort of, lockdown, or restricted movement measures is going to severely impact commercial real estate. So we're starting to see an easing of that. I would still say the market's nowhere near as robust as it was, but there is certainly an easing, and we expect that to continue. We don't think the federal government is going to shut down the country anymore for COVID. Certainly the executive branch is extremely disinterested in doing so, and we don't anticipate that happening. It may happen on a localized level to a certain extent, but we think that the marketplace will continue to be open, and we think that the population and investors will adjust to investing in an environment like this and picking asset classes and assets that they feel like are going to be winners moving forward, or have a better safety net than certain other asset classes.
Sure. How are deals being valued right now, especially given the limited comps?
Yeah, look, I think that's just really on a sector by sector basis. We can start with the sectors that are garnering the most liquidity. We've seen no movement at all really in cap rates in multifamily from where they were pre-COVID. A lot of that has to do with the fact that there's an active and robust marketplace for lending from Fannie Mae and Freddie Mac, which is really our specialty at Walker Dunlop, or has been the calling card of the business for the past 20 years or so. And our experience lending through Fannie Mae and Freddie Mac, I think we're the number one Fannie lender in the country 5 of the last 6 years, and we're really active in that space. We've seen interest rates, anywhere from 2.5% to 3%. For long durated fixed rate money with leverage anywhere from 60 to as high as 80% loan to value on assets. That's really helped continue to prop up multifamily property values, and then we've continued to see liquidity for industrial assets around the country, specifically Class A or newer built assets that seem to be highly desirable and designed for 21st century industrial tenants, and more specifically for logistical and distribution tenants, which that business continues to expand. So we've seen cap rates, stay stagnant in that sector as well, if not, further compress. Office has really been on a location or an individual submarket by submarket basis, depending on what the nature is and of the virus in those particular markets. And then hotel and retail have been very challenged.
Mm-hmm. And what kind of financing is out there now, and how is financing evaluating deals?
Yeah, so look, I think from a liquidity standpoint, Certainly on the multifamily side, you have the agencies and you have life insurance companies that have been very active in space, and to the extent that investment banks are willing to take on securitized mortgage product, there is some securitized mortgage product available for multifamily as well. We're seeing similar type activity in the industrial space, and in the office space, we're seeing some level of liquidity from insurance companies, some pension funds, and some commercial banks, specifically for stable assets. The hotel and retail, again, very, very challenging from a credit perspective in those sectors. We have a client that just acquired a distressed hotel a couple of weeks ago in the Southeast, and they bought it with an equity partner. They closed with all equity. They didn't take any sort of financing. The financing that is available out there for those two asset classes, I would say, is higher single-digit capital, certainly lower leverage, and certainly a little bit of a discovery period in terms of what the underwriting will look like. I would caveat that that's the off-the-shelf type of financing. But if you look at individual submarkets, there are certain assets that just continue to outperform both retail and on a hospitality in the hospitality sector. So I think that you can. If you can isolate those assets, those will still garner some level of liquidity to them as well.
So don't write off the whole sector. If you've got a deal and it's a good one, it's worth pursuing, and you may be able to work out financing on it. Are there any new types of financing that you see becoming more active now?
So, look, I think people are looking at different types of governmental programs. There's something called PACE financing, which is financing that's really tied to sort of green initiatives at an asset
Right.
that is available at a certain level. I wouldn't say that's a incredibly liquid market, but it is available. Lenders don't like it because it trumps the first mortgage that's on the property, but it's an expensive capital, and the maturity date is about 30 years out on those loans. I would also say that look, there's certainly the advent of, or the reincarnation of, distressed credit capital that's been raised is abundant. There are lots of groups out there that have raised billions and billions of dollars. I mean, there's just a tremendous amount of liquidity that's been raised to step into situations where they're lending into a quote unquote distressed situation, and that higher yielding group of capital providers has really raised a tremendous amount of capital. Now they've also widened their return expectations, and they're looking for distressed opportunities, and they're looking to be able to get into credit situations where they're able to participate in equity upside. But that's where the bulk of the liquidity has been raised in the market. The softer touch or lower yielding liquidity, really hasn't been as active right now.
Okay, and also, I think you started to touch on this. What kind of limitations are lenders placing on borrowers in terms of loan to value, loan to cost, and other parameters?
Yeah, sure. So look, the loan to value covenants really haven't changed at all with Fannie Mae and Freddie Mac. They're also willing to provide capital where sponsors are cashing out of deals. I would say that on the banking and in commercial banking and insurance capital side, assuming that they're interested in a transaction, those LTVs historically, were somewhere in between 60 and 70%. We've seen those get dialed back to the 50 to 60% range in terms of loan to value, and then we've seen credit spreads gap out a bit. Albeit we've seen a substantial tightening in credit spreads from the insurance companies because they typically track their loans or their cost of funds tied to investment grade rated credit bonds that they can acquire in lieu of putting out real estate loans. So that market's tightened substantially with the Federal Reserve buying bonds, and it's tightened credit spreads. So we've seen that translate to tighter credit spreads from insurance companies on commercial real estate. They, for the most part, are still keeping their loan to value covenants lower than they historically were, and commercial banks certainly are, and their credit spreads are still substantially wider than where they were pre-COVID.
Okay. And in the past, relationships with lenders have benefited borrowers during a downturn. How important are those relationships in today's market?
Look, they're certainly very important. I would venture to say that certain asset class, I would say it depends on the situation. Look, there's certain lenders that just, regardless of the relationship they have with a customer, are not lending, not making new loans. Those decisions are made, at a much higher level than the individual real estate group. But, certainly I think relationships are important if you have assets that have issues, if you need forbearance, if you need, a reduction in your credit spread or restructuring of your loan, or you have a maturity coming up on an asset that's really not refinanceable today. Having a great relationship with the lender, that's where you're going to see more leeway and flexibility. I think the relationships are certainly really are more material right now in terms of dealing with existing problems than they are accessing capital for new originations.
Okay, so a good thing to keep in mind then as you're making these various decisions. Interest rates are low, have been further reduced. It's great for investors, but how has it impacted lenders?
Yeah, so interest rates are, look, yields are down. So, I think there are lenders out there that are trying to keep their spreads wider and saying we're open for business, but we want to be compensated for it appropriately. And then, there's just not the transactional volume. So we'll see how much business they're actually able to do. And then, there are other lenders out there, the insurance companies have had to come down into the, high 2% range to win business on multifamily assets, for example, to compete with the agencies. There's more spread available in the commercial space because you don't have the Fannie Mae and Freddie Mac product to compete with. But it's certainly a lower yielding requirement, environment. The yields are roughly, when you look at it and you combine LTV and where you need to get to, they're probably wider. They're certainly wider than where they were pre-COVID in terms of getting to a full leverage loan when you need to blend in subordinate capital. But really what we've seen in the marketplace is the true, call it, true AAA tranche of a securitized bond or an extremely low leverage first mortgage. We're talking about 40% and below. That money is actually less expensive today than when it was in February or January of this year. It's the balance of the capital stack, the subordinate bond classes, or alternatively, increased leverage in terms of subordinate debt tranches. That pricing has gapped out substantially, and has said, hey, there's a problem in the marketplace. There's a lot more risk here. That capital is the pricing on that capital has widened anywhere from 200 basis points to as much as 700 or 800 basis points from where it was, depending on who the capital provider is. And the senior most portion of the capital stack really has benefited from the money in the marketplace from the Federal Reserve and the Treasury. So those are the kind of differences you're seeing.
Yeah. And I imagine that's going to go on for a while. I mean, it sounds like interest rates are staying low for the foreseeable future. Is there anything lenders just can't do now? What kind of limitations are their firms or their investor groups placing on them?
I'm sorry, can you say that again?
Yeah, I wondered if there's anything lenders just absolutely can't do that maybe their firms aren't letting them do, or depending on the type of lender, their investor groups don't want them to do.
Yeah, look, there's relative illiquidity in the construction financing market. There's relative illiquidity in a very, very low debt yield or a vacant building, and particularly in an urban infill location, maybe where they're relying upon a commercial use re-tenanting scenario. There's relative illiquidity in the hotel sector, certainly for hotels that are destinations for business travel or convention travel. Anything that you sit there and you say to yourself, hey, is this use, what's the direction of this use going? Where do we think rents are going in this particular space? Or where there's a lack of certainty or direction, that is going to create levels of illiquidity.
Mm-hmm. And what about with the retail and the hotel? What about if they've got loans maturing and they need to refinance?
Sure.
Are there going to be ways to do that now?
Yeah, I mean, look, it depends on the asset location, depends on the credit metrics of the transaction, how much leverage was on the transaction, where market rents could be today for retail, where what the trajectory is and the belief is in terms of the direction the hotel is going to go. When is it going to be able to have a normalized level of business? So I think those factors really will, and who the sponsor is, will drive whether there can be a bid for a refinance. If there is no bid for a refinance, there has to be a discussion with the existing capital provider in terms of what to do. Certainly, capital providers have liens and mortgage positions. They have the right to accelerate their position. They have the right to foreclose on an asset. Our experience has been that most lenders don't want to take back these types of assets today because they're worth substantially less than they were. And then also, a lot of times they've made loans to borrowers who are probably best suited to execute a reposition. So the conversation really has to be had with the lender in terms of, if you want me to put new capital into a deal, you as a sponsor have to decide what you believe the asset's actually worth, and then there has to be a discussion with the lender in terms of what their debt exposure is relative to where new capital needs to go into the deal. And these situations are what we like to call workouts. Is there some level of debt subordination to new equity? Is there a reduction in interest rate? Is there an extended forbearance period on interest? How much new capital is the sponsor putting into the deal? What's their return going to be? I mean, these are all situations that we could talk about ad nauseum, but it's typically that's the typical conversation that we're having with clients on these types of assets right now.
Okay. Now, broadening this out to other sectors that are performing better right now, what are some of the biggest problems that you've seen coming up or heard of coming up, and what are your recommendations to circumvent them?
Yeah, look, I think if you own an asset, you have a loan maturing, and you have an asset that's in a market that doesn't that's trajectory is going to is moving south, or you have an asset that you think is going to be uncertain. I think to be ahead of the curve a little bit and to figure out and be honest with yourself about what the value of the asset is. And then certainly be proactive in having a conversation with the lender on that asset in terms of, I think telling them we're committed to the asset, but we're committed at this level of valuation. And this is where it makes sense for us. And I think sometimes you have to take into account also what your tax recapture is through depreciation, or if you've 1031'd into an asset and have additional tax liability. These are all things lenders are going to look at in terms of how much capital you have in the deal, what your commitment is to the transaction. How much you have to lose versus they have to lose. I think that's, part of the discussion.
Okay. As borrowers are getting their information together and evaluating their needs versus what they can live with, what possibilities they can go with, what would you say is the most important information lenders need from borrowers right now, and how does that differ from pre-COVID?
Yeah, look, certainly we've seen lenders, looking at, more closely what rent collections are for, income producing assets, looking at operating expenses, certainly trying to get a feel for, what's going on in the comparable set for those assets, and, really trying to determine, the direction of an asset in a market is, and trying to figure out, where the, call it bottom is, or where the market actually is at that time. I mean, there's just tremendous uncertainty.
Mm-hmm. What kind of information are lenders requiring about the tenants, and what level of detail are they looking for?
Look, any sort of level of information that they're asking for is really determined by what's in your loan documents in terms of what you need to actually provide a lender. But we have clients that, a lot of times will provide additional information above and beyond because of the relationship they have. So look, again, they're looking for, I think really the two big things I think lenders are really looking at right now, or three are, what are the collections? If tenants aren't paying rent, why are they not paying rent? What are they asking for? And then three, lenders looking at property taxes and assessments, and seeing if some of the cities and municipalities are increasing their tax burden, going forward here. I think those are the big things.
Okay, thank you. Now let's turn to some questions from the audience. Along these lines, we do have somebody asking about your recommendations from both sides. You were just talking a little bit from the borrower side, some of what they need to provide in the way of information. What would you recommend from the lender's perspective as well?
In terms of what a lender should be asking for?
Yeah, I think so.
Sure. Yeah. I mean, look, I think they should be looking at, again, the rent rolls on assets, collection history versus where it is today. I certainly, if it's a commercial building with commercial leases, they should be focusing on the credit quality of the tenancy. I think is a huge thing here, and then also looking at in a marketplace where new leases are getting signed. Even markets where there's been a lot of stagnation and very few transactions, there are some leases getting signed. Certainly not at the robust velocity that there was, but I think a lot of those things are very, very telling. And then looking at who the tenants are that are signing those leases, and there's certain motivations behind those, but understanding the nature of the markets that you're in.
Okay, sure. What about construction financing? And that's something we didn't get a chance to touch on yet. What are lenders' views on construction right now, and how are they approaching it?
Yeah, so look, that's a pocket of substantial illiquidity in the market. There are some entrepreneurial commercial banks that historically have only provided construction financing to the market. They continue to want to provide construction financing to the market, albeit, if they were at 60 or 65% of cost, they may now only be at 40 or 50% of cost. You still have a few investment banks participating in that marketplace, and then a couple of the insurance companies have put together some higher yielding type capital to try to enter into that market as well. In some ways, being in a construction loan right now is better than having an existing asset, because you have an interest reserve built in, and so long as you're able to continue to construct the property during the cycle, you're in some ways in better shape than you are having a property that may have collection issues and a higher debt burden because of it, without an interest reserve built into your facility. So, but look, certainly very illiquid spot in the marketplace. A lot of people think that certain sectors of the marketplace are oversupplied, or certainly a lack of demand right now. And certainly in my estimation, a great time to start a new development would be today. There's no better time to build than in markets of illiquidity, because your labor pool is more expansive. It should drive down your costs a little bit on the actual hard construction end, and then you'd be delivering into a market that's going to have relatively no new supply in 24 to 36 months, and that should that product should see demand. Our expectation is this will not be the new normal here for the next 3 years. At some point, we will turn the corner. So,
do you see possibilities for getting new construction financed over the next few months as more municipalities open up and permits are able to start flowing again? Do you see possibilities going forward, say over the next couple of months, of getting new financing constructed as opposed to some things that were already underway?
Yeah, I would tell you that there's just been so much liquidity that's been raised in the marketplace to look for distress type credit scenarios. And it's very hard to see that there being the amount of credit coming into the marketplace that that the capital's been raised for. So we think that money's going to have to go out into other places at some point, and we think it'll get pushed into, the development space at some level for sure.
Okay. Staying on construction for a moment, we've got a question wondering specifically about whether it's a good time to consider multifamily construction.
Sure. Look, I'm of the opinion that the Federal Reserve policies have continued to increase the, what they call the wealth effect, or this gap between haves and have-nots. If you have hard assets, you're able to benefit. The commercial real estate, you have been able to benefit from, refinancing it at a much lower rate, increasing your cash flow, pulling out more capital, increasing your leverage. We've seen cap rate compression this cycle. That's really helped prop up values while you haven't had the type of, real net effective rent growth in most asset classes, over the last decade. And then, certainly in the public markets, look at the valuations on stocks. If you were able to own a stock portfolio, your stock portfolio, hasn't gone down particularly much. And in many cases, it's increased in value. So, you're continuing to see this gap. So, the general population, it's very, very, wages have not gone up. It's very difficult for them to aggregate down payments. And, we would expect that even if, home mortgage rates are 1 or 2%, it's immaterial in the scheme of things, in our opinion, because we think that it's very, very difficult to aggregate a down payment for the general population for housing. So we think that will relay into an increased demand for rental apartments. Also, I think some of the level of the uncertainty with the virus and what's going on, I think also creates, certainly, from the younger generation, the ability to have more flexibility to move around, which again, we think will increase the demand for rental apartments. So we're actually very bullish on multifamily, and we expect to see further cap rate compression in the multifamily space. If, cap rates are anywhere from, 3.75% to, call it 4.5% in markets that have, the right, call it political climate, and in some of the urban infill locations, we've seen cap rates expand substantially, primarily due to rent control, rent stabilization, such as in, markets like San Francisco or LA, New York City. So that is a separate risk. But, we would expect in the free markets to see continued cap rate compression. It wouldn't shock me if we were having this conversation this time next year and we were talking about low 3% caps on multifamily in certain segments of the marketplace because of that. Just because of where the cost of money is.
Okay. And I've got somebody wondering, I guess it's the $1 million question. Do you think that the interest rate will get into the negative?
I think that if Trump gets reelected, he will put so much pressure on the Federal Reserve that we will go negative. It seems to me that they're very sensitive to the comments that he makes, specifically Powell is. But if Biden wins, I don't believe we will go negative now.
Okay, so really it becomes a political question. Of course, we've got a presidential election on top of COVID. It's a big year in a lot of ways this year, isn't it? We are running close on time, and if anybody's got any last questions, please do send them in. We can still answer them. But in the meantime, do you have any final thoughts for investors on what they need to be thinking about, how they should be preparing for the next couple of months relative to transacting deals?
Yeah, sure. Look, I think that, the focus on just saying, let me go out and find a distressed transaction, which seems to be the flavor of the month, shouldn't necessarily be one's focus. I think one's focus should be on buying, high quality real estate that's extremely well located. The best locations always recover the first. And things are also always never as bad as they appear to be, in my opinion. So before you know it, the market will be back again and humming along. So, my recommendation to people is to try to buy the best locations, Don't overlever assets in a period like today, and be passive but aggressive, because the opportunities will come and then they will pass you by quicker than you realize.
Okay, well, that all sounds like great advice. So hope everybody was taking notes, but if you haven't been, not to worry, we will be sending you all notification when the recording is available. We are out of time, but tune in every Thursday for snap sessions covering important issues for multifamily and commercial real estate. Thank you again to our sponsor, Walker & Dunlop, and Aaron in particular. Thank you so much for this very helpful discussion.
Thanks for having me. Take care.
You too.